Hi everyone, my name is Siwe and this week we'll be going through balance of payments and exchange rates. Now let's start off with balance of payments. The balance of payments shows a record of flows into and out of the economy. Flows of what, you ask? Well, these are flows of goods, services, capital flows, and transfers. Perspective is key. It's how you think about it all. Economies trade with each other. As an individual, when you make an online purchase from an e-store based in China, you have contributed to trade. You have paid, sent your money to a bank in China, and in return, you receive goods. The balance of payment looks to account for and categorize all of these transactions by the economy. Now we have different balance of payment categories. One being the current account, the second one being the financial account, the third one being a capital account, and the fourth one being central bank reserves. The current account records imports and exports of goods and services, transfer payments, and interest income. When calculating the current account, the formula is as follows. It is your exports minus your imports, plus your interest income, plus net transfers. So, in essence, the current account is equal to net exports plus interest income plus net transfers. The financial account shows the net of investment flows into the local economy against the investments out of the local economy to economies abroad. The capital account records once-off transactions like capital transfers. Central bank reserves records changes in foreign assets owned by the central bank. For example, gold, US dollars held by the South African Reserve Bank, etc. So, ultimately, balance of payments is equal to your current account plus your financial account plus your capital account plus your central bank reserves. So this is what you need to know. How to establish the credits or debits. You credit an account for an inflow into the local economy and debit an account for an outflow from the local economy. For example, if a South African citizen purchases a soccer ball in Italy, we would debit the current account and credit the financial account. Or if an Italian tourist purchases a soccer ball in South Africa, we would debit the financial account and credit the current account. Note that every debit has an equal credit. What goes into the accounts? It's not rocket science. Textbooks often list examples of things that fall under these accounts, and as a result, examiners avoid giving straightforward scenarios. However, if it sounds like the purchase of a good, it's current account, and if it sounds like an investment in a financial asset, it's financial account. Now let us look at exchange rates. An exchange rate is the rate at which you can purchase a unit of foreign currency using the local currency. For an example, it costs 15 Rand 70 to purchase $1. Now, perspective is key. It's how you think about it all. You can only make purchase of goods or invest in the USA economy using US dollars. If you are a South African citizen who wants to invest in the American economy, you would first need to convert the South African rands in your possession to US dollars. Now let's look at the appreciation and depreciation of exchange rates. Let's say the exchange rate changes from 12 Rand versus the US dollar to 14 Rand versus $1. This means that the South African Rand has depreciated and the dollar has appreciated. You need 2 Rand more to buy a single dollar. And let's say the exchange rate changes from 12 Rand versus $1 to 5 Rand versus $1. This means that the South African Rand has appreciated and the dollar has depreciated. Graph 1 depicts the demand curve, whereby the y-axis label is the pound versus the rand. Remember, perspective is key. For you to invest in the British economy, you need pounds. So, what could cause you to want to invest in the British economy? Well, let's say the Bank of England raises interest rates. You'd invest more of your money in the British economy to capitalize on this high rate of return. Or, let's say domestic prices rise. If prices in South Africa rise, British goods become relatively cheaper. Obviously, individuals increase demand and consumption of British goods, resulting in imports rising. Remember, perspective is key. They need pounds to buy these goods, so demand for pounds increases. The same would apply when foreign prices lower. Other reasons that would cause you to invest in the British economy are if you speculate or expect the pound to appreciate in value, if you expect higher profit opportunities in investing in the British economy, or regulation making it easier to invest in or purchase from the British economy. Graph 2 depicts the flip side of the demand. Individuals increasing their demand of pounds means that they increase their supply of the opposite currency. For demand to buy pounds, it must supply rands. Graph 3 depicts the supply curve with a y-axis label of the pound versus the US dollar. Remember, perspective is key. For you to invest in the South African economy, you need to first acquire rands by selling or supplying your pounds to the market. So what would cause you to want to sell your pounds? For example, lower prices in South Africa's economy or higher prices in the British economy, which would mean increased exports for South Africa. You need rands to buy South African goods. Or higher South African interest rates. You need rands to invest in South Africa to capitalize on the higher rates of return. Other things that would make you want to sell your pounds are speculated or expected rand strength, higher expected profit opportunity in South Africa, or investor-friendly and export-friendly regulatory changes in South Africa. The next graph, graph 4, depicts the flip side of supply. Individuals increasing their supply of pounds means that they increase their demand of the opposite currency. Supply of pounds increases to satisfy increased demand of rands. Now, moving on to the graphs. Now here's a life-saving note for you students. Remember to always ask yourself, what is the y-axis label? An example label we can look at would be the price of the pound versus the rand. This means the graph looks at the demand and supply of pounds only. Next, let's move on to purchasing power parity, which dictates that after converting a dollar to rands, the rands will have the same purchasing power in South Africa as the dollar did in the USA. The exchange rate, the dollar versus the rand, is equal to the cost of goods in the USA versus the cost of goods in South Africa. We have three different types of exchange rate regimes. One being the flexible exchange rate regime, another one being the fixed exchange rate regime, and the third one being the crawling peg. With the flexible exchange rate regime depicted in graph 5, the exchange rate is determined by forces of a free market. This is the model that we have been looking at so far. With the fixed exchange rate regime depicted in graph 6, the central bank sets a desired exchange rate. Remember the balance of payment reserves? The central bank adds to or depletes reserves to keep the market at the targeted exchange rates. Now, the crawling peg is like a fixed exchange rate regime, but it follows a path set by the central bank. Now, here are some of the things that you need to note in conclusion. With reference to the graphs, start with the axis to establish the currency that you are looking at. Establish whether we are shifting the demand or supply curve based on the given scenario. Establish whether there is an increase or decrease of the shifting curve. With reference to depreciation and appreciation, look at the given scenario and follow the steps of the graphs to establish whether the equilibrium exchange rate has increased or decreased. If you are given a scenario but are not given a graph, make a quick sketch of your own graph. This not only saves you time, but it guarantees that you'll get the marks. In Ecos, graphing is the best proof of understanding. With the purchasing power parity, know the equation. Simply substitute the given values, manipulate the equation to find the missing values. Keep in mind that in the event that PPP does not hold, the exchange rates will adjust up until the PPP holds. That will be all for this video. All the best for exams, guys.